We're going to continue on this theme right now because our next guest says that the European debt crisis will take some time to be resolved. But once it is, confidence comes back to the U.S. market. Stocks could mount a big year-end rally. Doug Cote is with us now. He's chief market and strategist at ING Investment Management. He's with us from Hartford, Connecticut. So, Doug, by implication, you think that the European Union, the Troika, however you want to define the terms, are actually going to come up with a plan before the end of this year that brings confidence back to U.S. stocks?
Well, it's important to note that all they have to do is build a fence around the crisis. They don't have to solve the problem. I think that's a mistaken view. It's going to probably take a decade to work off all this debt. But as long as with this summit this weekend and next Wednesday, they put a fence around the problem, then we can focus on fundamentals, and fundamentals have been marching forward, and that's what's driving this market forward.
So I want to get back to the fundamentals in a minute, Doug, but basically you're saying if European leaders can replace the plan to have a plan with an actual plan, that's enough to get stock markets around the world to move higher.
Yeah, I don't want to say much to do about the euro lately in the news, but that's true. All they really have to do is build an effective fence, and this bank recapitalization, whatever form it takes, it seems like they're serious. It seems like they're going to get it done. I'm not as worried about the detail because it seems like the policy really is good this time, and it hasn't been in the past.
So, Doug, let's get back to the fundamentals then. We're in earnings season, as many people often point out. U.S. companies have a lot of cash on their balance sheets. A lot of CEOs have just, quite frankly, been afraid to spend it or afraid to use it because there is this crisis of confidence. So in what way is that going to move stocks, and in which direction before the end of the year?
Well, first I want to point out a story that I think is being missed by the market today. It was announced today, it was in the front page of the Wall Street Journal, how the Fed is going to target their actions on the housing and mortgage problem, and that's going to, they're trying to drive interest rates even further lower, and I think that's a big driver of today's markets. That's one big fundamental. The second driver really is corporate profits. We're in third quarter earnings season, and companies are continuing to put up good numbers. As a matter of fact, with 111 reporting, we're at 13.5%, and also top line is growing well, 9.5%. And companies have been continuing to be able to get it done because they're going overseas, they're going to the emerging markets, and that's where the demand is. So U.S. corporations are in a great spot right now because they're getting not only domestic but global revenue streams, and that continues.
Doug, it sounds like you're pretty optimistic then for fundamental reasons. Also, as you just alluded to, the Fed being supportive. So the S&P 500 trading around 1229 right now. Where do you think it can go, and by when?
1350 by the end of the year. That's about another 11%. We think it is with the focus, with global risk, a fence built around Europe, the focus on fundamentals, not just corporate profits, but manufacturing. Look at the Philly Fed report yesterday. It was a 30-year sequential high. Manufacturing continues to get it done in the United States. And also, we think consumers, retail sales are at an all-time record high. Last month got revised higher. This month was a big surprise. The consumer is much stronger. That's 70% of the economy, and that bodes well for the market going forward.
Doug, a lot of people out there who hope you're right. 11% higher from this point on till the end of the year would be a great move for people who own stocks. We thank you so much for joining us. Doug Cote there, Chief Market Strategist from ING Investment Management. You heard